The U.S. housing market is sending mixed signals, and it's leaving builders in a tough spot. While builder confidence inched up slightly at the end of 2025, it remained firmly in negative territory, highlighting the ongoing challenges they face. This raises a crucial question: can the housing market recover in 2026, or are we in for a prolonged slump? But here's where it gets controversial. Some experts argue that the current dip is a necessary correction after years of booming prices, while others fear it signals a deeper economic downturn. And this is the part most people miss: the impact of rising construction costs, tariffs, and buyer hesitation due to affordability concerns are creating a perfect storm for builders. According to the National Association of Home Builders, NAHB/Wells Fargo Housing Market Index, HMI, builder confidence for newly built single-family homes rose a mere point to 39 in December 2025. This is a far cry from the break-even point of 50, indicating that builders are still pessimistic about market conditions. Throughout 2025, sentiment levels consistently lingered in the high 30s, reflecting the persistent headwinds facing the industry. For the full story, visit https://www.nahb.org/news and economics/press releases/ builder sentiment inches higher but ends the year in negative territory. https://www.nahb.org/news and economics/press releases/ builder sentiment inches higher but ends the year in negative territory. Adding to the complexity, Federal Reserve officials are closely monitoring inflation, particularly shelter costs, which make up a significant portion of inflation indices. Fed's Miron recently stated that if shelter inflation doesn't decline, it could alter the overall inflation outlook. Miron also expressed optimism about GDP growth and lower deficits due to tariff revenue, but remains cautious about selling mortgage-backed securities, fearing potential losses for the Fed. Meanwhile, in Canada, a benign CPI report has shifted focus to the upcoming NFP report, expected to show weak job growth and a rising unemployment rate. Shifting gears, let's delve into the intricacies of inflation. As Fed Governor Miron explained, calculating shelter inflation is far from straightforward. The Personal Consumption Expenditures (PCE) price index, the Fed's target, includes housing costs for all households, which might not accurately reflect current supply and demand pressures. For instance, while market rents for new tenants surged post-pandemic due to high demand and limited supply, the PCE shelter index lagged behind as rents only adjust when leases are renewed. This lag created uncertainty about how long elevated shelter inflation would persist. However, Miron now believes this lag has been addressed, leading to expectations of a faster decline in PCE shelter inflation. Is this a sign of a turning point for inflation, or are we in for a longer period of elevated prices? In other news, the candidacy of Kevin Hassett for Federal Reserve Chair faced unexpected pushback from individuals close to President Trump, despite his initial frontrunner status. Concerns about his perceived closeness to the president seem to be the main issue. This development adds an intriguing layer of complexity to the Fed leadership transition. Finally, Fed's Williams emphasized the central bank's focus on balancing job growth and price stability, highlighting the importance of reaching the 2% inflation target. He also noted that monetary policy has shifted towards a neutral stance from a previously modestly restrictive one. As we navigate these economic currents, one thing is clear: 2026 promises to be a year of significant economic developments, with the housing market, inflation, and Fed policy at the forefront. What are your thoughts on the future of the U.S. economy? Do you think the housing market will rebound, or are we headed for a prolonged slowdown? Share your insights in the comments below.